A lot of people who go about their investment journey will read books about whiz bang products and someone who did something really fantastic. And a lot of that is based in sales. A lot of that is based in literature. What about the actual empirical research, the sorts of things that win Nobel Prizes? How familiar are you with those things and with that evidence? Today, we're going to be speaking about those things with an expert in the industry. Stick around. This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto. This week, we're speaking with Patrick Frigon. He is a seasoned financial professional with over 30 years of experience in institutional brokerage, portfolio management, hedge funds, and national mutual fund distribution. He now shares insights from his decades of research and work in the industry, and he helps advisors take a more academic approach to evidence-based investing. Patrick, how are you today?
I'm doing great, John. And you, how's it going?
Very well. On this podcast, I have a number of different people who come to speak to me about various things. Some of them represent products, some of them are journalists, some of them are academics. But I wanted to have you on today because we have not really had a meaningful conversation about the science of investing, the evidence that has been prevalent. And a lot of people who work in financial services giving advice to retail clients will know about homespun things like what Warren Buffett says, for instance. And Warren Buffett is great, but they will not be as familiar with the people who win Nobel Prizes and who really move the ball forward in terms of evidence, things that can be proven, things that are empirical, and things that hopefully help people make better wealth decisions. So I was hoping we could talk about that today.
Oh, absolutely. I'm more than happy to do it with you, John.
So let's begin by talking about one of my heroes, and I think one of yours as well, and that's Eugene Fama. I've got a few things I can say about Gene. I've had a chance to hear him lecture on 3 or 4 occasions, but I'm wondering if I could just ask you open-endedly, tell me about who Eugene Fama is and let the people listening in get a handle on who this guy is.
Sure. Eugene Fama basically came out with the hypothesis of a market efficiency or efficient market hypothesis, basically saying that all the information in the market is already available. It's already there. And what he's saying is basically when you look at the price of a stock, all the information that is represented in the price of that stock at a specific moment represent all the information there is to have. So basically all the past information, all the present information, but more importantly, all the future information. And what is future information? Well, it's all the anticipation. You have analysts following a company. They come out with earning estimate. We believe that the company is going to do such and such in terms of earnings per share. This new project is coming out. This new product is coming out. Those are the future project insiders trading in there. And everything is reflected in the price of that stock. So what FAMA is telling us is that basically from the information, everybody think that they have an information advantage. I said, that is an illusion. Forget it. You will not have an information advantage thinking that you'll be able to beat the market. What he's saying is he's not saying the market is perfect. He's saying the market is perfectly efficient. So all the information is over there. So I remember when I was in the business, on institutional sales, we would have would have all the information come in live. And the next morning I'd read it in the Globe and Mail. So a lot of people read it in the Globe and Mail. Oh, I'm well informed. It's in the Globe and Mail. Well, guess what? This is whole news. I had it like 12 hours ago and the price already adjusted. What Fama is saying is also very disturbing because he's saying that research doesn't work.
Can we
it's not like that.
Take a moment to maybe explain the efficient market hypothesis in terms of its 3 variations: weak, semi-strong, and strong?
Sure.
Are you?
Yeah, I'm familiar with that. Yeah, of course. Yeah. Basically, the weak form is basically when you look at past information, and what you're referring to past information is basically technical analysis. If you look at technical analysis, and I remember when I was in university, or even our teachers, it doesn't work. So what you try to do is figure it out from past prices, looking at trends and trying to determine what the future is going to be. But the thing is, what will move the price of a stock is new information, and nobody knows what that new information is going to be. So that's the weak form. The semi-strong form is basically current information. So all the information that we have right now, the thing that we know right now is already reflected in our price of the stock, and you could do all the analysis that you want, but it won't work. And the strong form is what's referring to is all that future information, the anticipation, but also insiders, what the insiders are doing. Obviously, insider trading is illegal. There's some rules for that, but let's say it's not illegal, or let's say some people are doing it. You got to do a lot of that in order to really think you're going to beat the market, and it's just an impossible task. And that's what we're seeing.
What I'll do is I'll take a moment to see if I can paraphrase this for the people listening. What FEMA really showed is that the idea of stock picking as a viable value proposition is a bit of a mugs game, and that it's very, very difficult to do consistently and reliably, especially net of fees, because what you're doing is you're trying to pick winners when everything is already perfectly priced, and there's no real advantage because the prices, as soon as there's new information, it changes literally the price in a second.
Yeah.
And you're not going to be able to capitalize on the new information because it's already changed and it's already reflected in the price.
And I think, John, that people don't realize all the people involved in the market. We're thinking about mutual fund companies, so you have the managers, the analysts, but when you start looking, there's a lot of people involved in that market. I mean, look at hedge funds. So a hedge fund company comes in there and says, oh, that company, I think that company is too expensive, I'm going to short it, or I think this stock is dirt cheap, I'm going to buy it. So, and they come in, they have different opinion than somebody else, and they have all those pension fund managers, you have all those endowments funds, you have all those sovereign funds coming in, the trading models. So there's so many people involved in that market. So to really think that you could outsmart everybody.
Yeah, it's pretty hubristic, I think. And there's a lot of hubris in the industry and a lot of, sort of machoism that isn't necessarily justified.
Yes.
Gene Faba did some research with a research partner by the name of Ken French over at the Tufts School at Dartmouth. And in the end, that led to what is now known as the Faba French 3-factor and more recently the 5-factor model.
Yes.
Wondering if you could maybe take a moment to walk us through what that is.
I think that what Fama and French wanted to do is find a way to explain the return of a portfolio. How, when I look at a portfolio, where does the return is coming from? And that's why they came out with a 3-factor model. Because at one point in time, financial theory was basically, the beta, return to the market, and plus the alpha. And we say, maybe there's more to that, because sometimes there's different places. So what Fama and French came out is they first say, you got to be invested in the market. So the market will always outperform cash over the long term, obviously, because we never market correction, cash does better, but over the long term, market will do better. So you have a kind of a premium, a market premium. So you're going to return coming from the market over the long term. But then you say, but that does not explain everything. And then you start looking at market capitalization. So what he realizes is that smaller companies will do better than bigger companies, obviously over the longer term. So over the long term, you have a small cap premium. So because you invested in small cap and they're riskier, you should be making more return. And that's the whole thesis is return and risk. That's the couple that are inseparable. So if you want to have more return, you got to take on more risk. Smaller companies, yes, do better, but they're riskier. And then you got mid-sized company who are basically less risky than smaller ones. So they perform well versus large caps. So you have kind of this progression of small giving higher return, medium in the middle, and then large one giving a little bit less return over the long term. But we're talking 40, 45 years, because right now, the last 20 years, it's been large cap growth. And then he's coming to the last point where he says, value, if you invest within a value style, looking for cheaper companies, will tend to do better over the long term. But the thing is also a value stock, the reason why the stock is cheap, usually there's some problems with the company. There's some stuff happening. That's why the investors do not necessarily like the company. That's why it's cheap, more risk to it. But that risk premium is being transferred to a higher, longer term return. But again, it's over a 40, 45-year cycle, because now in the last 20 years, value has been basically, the value premium has not been negative for the past 20 years. Over a 40-year cycle, that will become positive.
It's interesting because there are a lot of people who will say they're a value investor, and then they'll talk about Warren Buffett because he's perhaps the world's most famous value investor. But it's Gene Fama and Ken French who showed the world empirically why value investing works and why it generates higher returns. But it's funny because Fama and French are not household names, but Buffett is.
Yes.
It's just a lament that people that work in the business have in that there are people who gain a certain degree of notoriety as a result of their prevalence and just being in the public consciousness. whereas the people who actually produce the information with rigor and explain why things are less well known. And that's just a frustrating aspect of academia.
Yeah,
Let's
it is.
move on. Let's move on to a guy that is often compared to Eugene Fama, and that's Robert Shiller. So
Mhm.
both Fama and Shiller won the Nobel Prize in 2013. But I think the people in Scandinavia are a bit cheeky because they gave the awards to both of them, even though they're seen as being opposite ends of the spectrum. So maybe take a moment to walk people through who Robert Shiller is and what his research says. Schiller did some work with regards to something called CAPE, cyclically adjusted price earnings ratio.
Oh, yeah.
And what he talked about was, for lack of better terminology, I don't think Schiller would necessarily agree with the word, but he talks about things that we colloquially refer to as bubbles. He was the person who called the real estate bubble and
Mhm.
coined the phrase irrational exuberance at the turn of the millennium.
And he
So
said,
Schiller used the term in testimony to the Federal Reserve, and then Greenspan basically started parroting it a week or two later. But it was
sure.
Schiller who was the first to use the phrase,
Okay,
and
yeah.
Schiller ended up writing a book called Irrational Exuberance. So
Okay.
a lot of people see them as being, you either have to be a disciple of one or a disciple of the other. And I personally don't see an inconsistency. I very much respect all academic evidence, and I don't want to go around playing favorites.
Yeah.
So what Bob Schiller says is, and again, I've met him too, when prices get really ahead of themselves and securities start trading at really high multiples, there's going to be a longer term regression to the mean. And over, say, 10 years, if stocks have been trading at a very high valuation for a while, the expected return for the forthcoming decade from whatever point we're starting at with the high valuations will be lower.
Mhm.
And that's just a thing that you need to be able to understand and accept. So it's
Yeah.
interesting because Dabo would say, well, if the market is highly efficient, there's no such thing as a bubble, at least before the fact, you can't reliably identify it. And Schiller would say, well, but here's the evidence that shows that there are problems like this.
Oh, there is problem. And you know what? When you look at asset classes, they all produce a return. They all produce a long-term return. And sometimes they get ahead of themselves. And that's what he's saying. Basically, you know, you got, like we're talking right now, man, like large cap growth has been on fire for the last 15 years. And they're really cranking up their returns like there's no tomorrow. So everybody says, well, you know what? Large cap growth is the way to go. And then all of a sudden you see small cap value just basically, they're doing a return, but they're lagging so much. It's
Right.
not even funny. So, but what he's saying is that eventually you're going to have a normalization. You're going to return back to the normal. So what we could expect is that over time, small cap value will come back up, will have their glory days eventually over, I don't know when, but they'll have their glory days. And then everything will come back in line with what Fama and French is saying and what Schiller is also saying. He's saying basically, yeah, an asset class could do great over a certain period of time, but it's not eternal. And what Fama and French are saying, well, over long term, small cap does better, value does better, but that's over a 40-year cycle, 45-year cycle. Within that, yeah, you'll have those moving. That's what Schiller is basically referring to. These things will normalize over time. So to think that right now you should be betting the whole farm on large cap growth is a risky proposition right now because now
Absolutely.
we're seeing those multiple going extremely high. And but at the same time, I don't want to say bet the farm on small cap value because eventually come back. But when I
You
don't.
diversify. Okay, so let's see if we can talk about two other guys that I think will be a great jumping off point, and that's Charles Ellis, who wrote a book called Winning the Loser's Game,
Yes.
and another guy who might be the sort of the actual father of modern portfolio theory, which is Harry Markowitz.
Yes.
And a lot of what I'm hearing you say is let's start with Harry Markowitz.
Sure.
So Markowitz says you have to find ways to build portfolios, and different asset classes have risk return characteristics. Talk to me about portfolio construction using the insights of Harry Markowitz.
Sure. Absolutely. Well, I think Markowitz is the elegant solution to Fama and French dilemma, or mostly Fama. Fama saying, well, research does not work because everything is already priced down in the price of a stock. So fundamental analysis, basically, he's throwing out the whole fundamental analysis out the window, and they say, okay, what do I do now? And I think Markowitz is bridging that gap where he's saying, you know what? At the end of the day, I mean, what is important is the combination that you're making between your asset classes or between your different stocks. I think the brilliance of Markowitz is with correlation. And give you an example, a very, very simple example. You take two businesses, an ice cream business and a hot chocolate business. They don't move at the same time. So obviously, being Canadian, winter's coming. So especially here right now, it's kind of cold today. So basically, the hot chocolates business is very popular today, whereas the ice cream is a bit less popular. Ice cream was very popular last July. Hot chocolate is very popular right now. And these things move in cycles. So what he's saying is that the ice cream business has a return, has a risk. The hot chocolate business has a return, has a risk. But the thing is, they also have a correlation. They don't move at the same time. And that's where the whole genius of markets comes into that point. I'm saying, let's combine them with because of correlation. So when he takes into account correlation, now he can mathematically build an optimal portfolio. And that's what he's saying. He said, instead of buying either ice cream or hot chocolate, say, why don't you buy both? And he created the word and. So buy ice cream and buy hot chocolate. By having those two combined, you'll have a much more stable portfolio, giving you more return. It's what we call the diversification effect. That's why markets won his Nobel Prize for that. And that's how you want to, the portfolio is built by being diversified, and you're able to calculate it because of return, risk, and correlations.
And in terms of making better wealth decisions in portfolio construction, that means stocks and bonds, but also domestic and foreign, large cap and small cap. It means finding other asset classes, alternatives, private and public, and value and growth. There are different ways that you can slice and dice portfolios and diversify to get those correlation coefficients to the point where you can get a good return, but you can lower risk along the way. And you get this concept called an efficient frontier.
And I think that Markowitz came out with this phrase that said, the only free lunch in finance is diversification. That's the only free lunch. Again, meaning that if you diversify and you go, and just to make sure we understand, if you buy a growth fund, a U.S. growth fund, and you buy another growth fund, you're not diversifying. You're basically buying the same thing. So what he's saying is, buy something that doesn't move at the same time. So therefore, you could buy, small cap value versus large cap growth. You buy both together. They don't move at the same time. Now you get this diversification benefit that reduces the risk and sometimes will create more return. And he showed it with stocks and bonds, where if you
so let's just move on to Charlie Ellis, because I think he's the one person that I wanted to talk about, that I know you wanted to talk about, who does not have a Nobel Prize. So far, everyone we've talked about, Gene Fama and Bob Schiller and Harry Markowitz are Nobel laureates. But Charlie Ellis is not. He's a very, very accomplished academic, and he's written a fantastic book called Winning the Loser's Game, but he doesn't have a Nobel Prize. Too bad, so sad. But I'm wondering if we could maybe take a moment to talk about Charlie. What are your thoughts about him?
Oh, I remember when I was I was at university, I read his book, and at the time it was called Investment Policy, How to Win a Loser's Game. That was the first book, and he came out with The Loser's Game. And basically what he's saying is that he took the analogy of tennis. When you play tennis, you try to win the game by doing some good shots, and that's investing is the same thing. You try to win by making good calls, by selecting good companies. But he's saying, what? At the end of the day, when you start looking at people playing tennis, most of the time they're beating themselves because you hit the ball, out of line or in the net, and it gets pointed to the opponent. And many times, you're basically the opponent not do great shot. All he's doing is just returning you the ball, and then you just hit it, and then you miss your shot. Then it's a point to the opponent. So basically, we're beating ourselves. And what Ellis is saying is basically with all those professionals, fund managers, pension managers, hedge fund, all those people, again, they're intricate into that market. So they are the market. So everybody is the market. So now what he's saying is that basically what you're trying to do is you're trying to beat yourself, which is impossible. So because basically all the investors, all the money managers and all that, they are the market. They represent the market. So to try to beat the market doesn't work. And that's what he's saying.
Yeah, and the way that I would use the tennis metaphor is to say you're trying to minimize unforced errors. So when I read the book, it was a long time ago. I was just taking up tennis at the time, so it stuck with me. It's like, okay, so look, you can try to make the perfect shot, but maybe don't try to paint the corner so perfectly to make sure it's in, because if you miss by a few inches and now you're wide, well, now you missed the point. Better to be 2 or 3 inches inside the line, and even if it's a little bit easier for your opponent to get to, at least you didn't beat yourself, because if you're outside the line, you've just lost, and
Exactly.
That's the thing. So the idea here is in making better wealth decisions, you have to reduce your unforced errors. You just, be maybe a little more cautious, not always swing for the fences, and just try to get good returns without trying to get the absolute best. So we're at the end already, Patrick, and I wanted to ask you the question that I ask everyone at the end, and that is, the podcast is called Make Better Wealth Decisions. If it was up to you, knowing all that you know about the evidence and of investing and research and empiricism, what advice would you give people to help them make better wealth decisions?
I would go index. I would be more invested into indices. A good one. I mean, S&P and all that, MSCI, because you own everything. You have everything in there. Yeah, of course, they're going to tell you there's some not so great companies, but Amazon's been in the S&P since 2005, and now it's in the top 5. But nobody would have kept Amazon for 25 years. And now it has massive success. But I think indexing is probably the best way to go because it's been proven. I mean, money managers are having a hard time beating the index, all kinds of biases and everything. And that's what FAMA has been telling us for 50 years. Charlie Ellis is saying the same thing. Just own the market. Just own the market. That's simple.
That's really wonderful advice. Patrick, I want to thank you for your time today. It's been a real pleasure.
Oh, thank you so much, John. It was great talking to you. Have a great day.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.